If you follow like a very well tried and tested path and you invest in quality companies and you just kind of hold them for a long time and don't panic, you will create life-changing wealth.
You're beginning to start the journey, which could change lives and families and generations.
If you're, say, a parent and you get investing started for your kids and you get them interested, well, they're more likely to become savers and not rely on the bank of mum and dad.
Put it into perspective, these companies actually don't make anything, literally. Like there's nothing, they're there really, on top of everything you've said.
They're going to put into orbit like the largest single thing we've ever put into orbit as one piece. And they have to like unfold it. Like there are some things that we haven't done as a species, and they're going to be doing it first. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. On this week's Wall Street Wildlife, the power of networking with other investors. We're also taking a look at a couple of highly speculative, mostly pre-revenue, hyper-growth companies, how we think about these in our portfolio. What does Aswath Damodaran have to say about investing in pre-revenue companies? And the big, beautiful bill is causing waves in the Senate. It's coming for a vote by 4th of July. What does this mean for our energy investments? Krzysztof, how are you, buddy?
I'm excited to be driving kind of for the first time in Europe. I leave from Poland and try to make my way down to Sicily via, I guess, Poland, the Czech Republic, and then through Vienna, Austria, and then over to Genoa. But it occurred to me that other than my uncle taking me to the racetrack this past week, my uncle was a former race car driver, so he kind of schooled me on like what it's like to really drive a car fast across curves and whatnot. I nearly pooped my pants. But it occurred to me that I never really drove in Europe before, other than Sicily, kind of like here and there, but like, so school me. What do I need to know? Drive on the left side of the road, right?
The left, like the American side of the road. You're good. I mean, check your geography. I'm not a geographer. Are those countries right? Is Austria on the way? Isn't it the other direction?
Austria is south, so I know we'll be stopping in Vienna. That's our first stop.
Okay, fair enough. Are you driving Uncle's Jaguar? What are you taking?
No, we invested in as smaller car as we possibly could for the Sicilian roads. So we got us a small Toyota, something or other, Iago, something like that. Because in the Sicilian roads, you really can't have a big car. You'll get stuck like a donkey in the cart.
I don't know. Like, it depends if you want to like treat the roads like a racetrack and be overtaking everything, or just kind of cruising and enjoying like the wind in your hair.
Yeah, no, Uncle would not let me take the Jag.
Okay, all right. I don't know that I've got any top tips. Yeah, take your time, enjoy the journey. Maybe if you have the time, stay off of like the auto routes and the autobahns and like use the small roads, because you'll save a ton of cash on tolls. I know you're American, so you're used to tolls. They can be really expensive. We hit some tolls on the motorbikes last year, and I think it was like 30 or 40 euros just for like one section of road for a bike. That's like, I had no idea they'd inflated so hard. That's really expensive. Don't stop in. Yeah, good top tip for Europe and the UK. Like if you're going to eat somewhere, don't stop in like one of those like highway services places, because they're just junk and they're overpriced. And find like a beautiful village somewhere, off the beaten track. Go gas up the car and, find some little cafe thing. That'd be a much nicer, authentic experience.
Okay, so you're equally at home on both sides of the pond, and I suppose Asia too. Is there a fundamental big difference between driving, across the U.S. versus driving across Europe? Is it kind of mostly the same feeling?
Most of my U.S. driving is in like snowy winter mountains. And so, that's how I formed my opinion, which is that US drivers are among the worst in the world. You guys drive too close and too fast on the highways. And I know your freeway thing where everyone can like overtake on every side. And there seems to be no appreciation about like stopping distances and like planning. which is why I'm always seeing, like, in the ice, I'm seeing like vehicles back to front on the highway because someone's clearly been going way too quick. They've got a bit ahead of their skis and then they've spun the car trying to do whatever emergency you don't see that sort of stuff in Europe very often. People are better drivers, but say in Italy they're fast drivers. So, you know, and on the big roads, be aware of people doing, well, like some of them there's no speed limit, so be aware of, if you think you're going quick, there's always someone else like doing twice your speed.
Oh, see, this is fascinating you say that, because just driving in Italy, I thought almost the opposite. I mean, in Italy, people are, it's almost, I don't know if the UK is that much different from, well, maybe it's just Sicily, but my God, in Italy, people are like tailgating each other within millimeters, but they're paying attention. So it seems like it's kind of a way more aggressive form of driving than I've ever encountered in the US. But the difference between left and right lanes are quite like known, and no one's texting in Italy. Everyone's just like kind of really driving.
Right.
So anyway.
Okay. Yeah, that's fair. I think different kinds of slightly sketchy driving, like the British drivers are among the best in the world. I was thinking this the other day, actually, like, because I can review about American drivers. Like, we should try and do each other's driving test. And like, I guarantee, I'm confident I could pass the US driving test with almost no preparation, just understanding what I need to do. I'm similarly confident that you would fail 3 times minimum. Most Americans fail 3 times before they pass the UK driving test.
Really?
Yeah.
Huh. Okay.
It requires you to actually be able to drive and maneuver and do like 3-point turns and reversing around corners and actually understand what all the signs say. It's tough. It's appropriately tough.
Oh, okay. Well, I thought it was enough to know which side of the road you need to drive on, and then you're good. Which when I drove in the UK, by the way, this is saying the obvious, but my God, like, it's so scary the first couple of days, because every instinct, you know, like the subconscious part of you that's not really thinking in moments realizes, oh shit, I'm on the wrong side, and then going on to exit ramp, like, you know, like everything curls up inside, like, oh my God, I'm going onto oncoming traffic. It's like not a joke until you anyway. Okay.
For driving in, I haven't done it myself, but there's like a road in China as you come from mainland China into Macau. So Macau and Hong Kong drive on like the British side, the left, and China drives on the right. So there's like some crazy junctions where you cross the border where you literally like swap from one side of the road to the other. Cool stuff.
Yeah. Okay. Well, fingers crossed that I make it from Poland back down to Sicily. If this is my last show with you, it's been a good run.
Great stuff. Good. Anyway, and I promise listeners I will not rag on American drivers anymore. We'll put that topic behind us.
To be determined. So, rumor has it you've been hobnobbing with some listeners.
I have. I had lunch with Paolo, who's one of our OG Patreons, and he's such an OG Patreon. He actually bought a Patreon membership for his cousin as well, who he's trying to encourage to become an investor and sort of think about investing. So I'm hoping they're both listening to this. So straight out of the gate, thank you very much, Paolo, for a delightful lunch at a very nice joint in central London. I got a ton out of it. And I mean, I will say, I don't want to go sort of too deep into specifics about Paolo's life, but he and I are very aligned. We've had a similar kind of career trajectory. We're interested in similar things. And we both sort of navigated the way into sort of financial independence and retirement in very, very similar ways. And we're both, I think, very much enjoying this lifestyle. So it was great. And we got to, over lunch, as well as swapping like life stories, we got to chat about a whole bunch of investments. And we're invested in very similar things, which is unsurprising because he kind of found us. I think he actually found us because he was a fan of yours originally, Krzysztof, when you were, I think possibly when you were like CMF Monkey at the Motley Fool. So yeah, kind of good stuff for like bringing together people of similar interests and now like actually swapping DD. And I do want to give a shout out a bit later in today's episode to one of our Patreons who brought an incredible investment to our attention, which is now like for me a double in 2 months. So that's valuable.
Yeah, getting to know actual people on the humane level is so important. we've talked about this nonstop, like the building of trust and doing this thing together. I have a question for you. As you were telling me that, it's so counterintuitive in so many ways that when we talk about how life-changing investing can be, how it still seems so hard to convince people to just take those basic steps and start. And I have a theory why. It almost seems like people are used to some version of it's too good to be true. Like, oh, sure, those guys did it. Or sure, those guys got lucky. Or sure, like, but that's not for me. Or it'll never work for me. Or some sort of weird thing. And I think that's why getting to know people individually can help maybe overcome that resistance, whatever it is. But my hypothesis would be family members should be more easily not convinced, but like open to trying investing if they haven't. And yet it's not the easiest thing in the world to, I don't know. What do you think?
No, I totally agree. And actually, I'm glad you asked that question, because like Paolo is also independently doing something that I've been doing for quite a long time. He's trying to teach his family and his close friends by actually leading them on the journey. So I've done this for the last 10 years for a bunch of family members, and I've rolled it out to a whole bunch of friends' kids this Christmas. Paolo's done the same thing. He's basically bought an investment gift for some younger family members, and then they've made, an investment decision, and he's kind of putting his capital at risk, but showing them over time, like the power of investing. It's not a scam. You can make mistakes and you can lose your money, but if you follow like a very well tried and tested path and you invest in quality companies and you just kind of hold them for a long time and don't panic, you will create life-changing wealth, and you'll be retiring in your 40s like Paolo and I did.
Yeah. So I want to make this concrete. Anyone listening to us right now, I would pause and ask, what one family member do you think you could say take out to lunch and say, okay, I can help you take the first step? Because it's if it remains abstract, you're never going to do it. But if you think, oh, my sister or my brother or my cousin or my second cousin or whomever, they might be open, and you actually take that step, you're beginning to start the journey, which could change lives and families and generations. So really encourage you to think about it concretely and then take that step and introduce them to, like, say, one basic principle, or how to open an account with something like public.com, and help them start.
And this could be advantageous to you as well in a couple of ways, right? So, I mean, not the least of which, if you're, say, a parent and you get investing started for your kids and you get them interested, well, they're more likely to become savers and not rely on the bank of mum and dad when they get to like their 30s or something. Like, you're sort of off, maybe you're mitigating future costs. But if you can get your friends interested in investing, and if they have different like subject matter expertise or things they're passionate about, this can actually be directly helpful to you as an investor. I don't want to turn this into like a shout out episode, but I got a message on X from a follower, M, and M basically said, like, thanks for doing this content, really enjoying like Wall Street Wildlife and the stuff that you guys are doing. He's in Brazil and he's a big fan of Mercado Libre. And so he uses it like almost every day, a bit like my use of Amazon locally. And I found that fascinating. We had like a short conversation, but I can't use Mercado Libre where I live, right? And it's a major part of my portfolio. And I love to get personal experience of the companies I own, maybe apart from the medical technology ones. And so if someone else who is like a trusted voice, who clearly understands investing and the market, if they're using these companies and they're happy with them, that helps me reinforce my own understanding investment thesis. So, if you can get a buddy interested and they're interested in, fashion or some other domain that doesn't light your fire, maybe once they become an investor one day, they'll start sharing due diligence back with you that might help your investing in the future.
Exactly. Yeah, it's the network effect. So I'm glad, you got that cool, sweet message from him. Only big problem is that he severely underestimates Humble Monkey and M brother, you gotta take a closer look at what Monkey's going on over there. Don't listen to Badger's smack talk. Take a look at the actual results that Monkey's putting up on the board.
Well, hey, like you can't argue with M's allegation or comment that I can't seem to agree with Chris on any of his mad strategies. Like, okay, you might be making money, but they are kind of mad strategies.
I see a banana and I grab a banana and then I eat a banana. What's so wild and crazy about that? But I do want to talk about later in this episode, specifically, that comment kind of triggered something I want to talk about in the inside of one of my recent King of the Jungle purchases and why it might look mad on the surface and why it's hard to pull off. But, so that'll be just down the road after we finish talking about our next topic. I think we can move on to the current kerfuffle going on with the big, beautiful bill that's being voted on, I think, in the next couple of days. Trump wants to pass it by 4th of July. And so I'm really interested in this because it impacts energy in the United States on a massive scale. And the current headlines are look pretty grim for basically all renewables. And so Elon took to X saying this is just completely asinine and backwards. And in summary, it does seem like this is a bill that's going to favor the legacy industries like gas and coal at the expense of the rate of growth of all the future renewables like solar, wind, and potentially battery, though I don't think that's actually the case.
I don't know the specifics of the bill. I don't know if you can bring some of it to life for us, but like we're at this transition point, I guess, in society where like we still need so much energy that we need like the legacy non-renewable stuff right now, but we're in this transition and like it's more economically viable to use renewables. Like it's becoming the cheapest form of power. We just don't have enough of it. So if this bill is literally like pulling the incentives for renewables and maybe adding, creating positive incentives for non-renewables, well, that's just ass about face, right? You should be going the other way. Because you need non-renewables, no argument. Well, we can't be turning off like coal plants and stuff, but you don't want to incentivize building more of them.
Right. No, that's exactly right. And one of the clips I listened to was a Republican senator from, I believe it was North Carolina, saying he's ready to vote against his own party because of how asinine and ass backwards it is to basically start cutting the incentives for the way we make more energy in this country. The fact of the matter is, it really is. This really does seem to be, I don't know how else to say it. If this bill passes in its current form, as though idiots running the country only acting in their own self-interest at the cost of the greater good for the country for the foreseeable future, because we know that we need more energy than ever. All of AI and national security depends on us getting more energy, and that things including, not excluding old stuff, but the new stuff is kind of limitless. So if you disincentivize things like solar and wind, you're basically sabotaging yourself for what? For the greed. I don't know. I'm calling it greed of legacy players. So it's completely asinine in the fact that it's becoming a bipartisan kind of, they're calling it a bipartisan issue. I'm cautiously, I don't want to say optimistic, but I'm cautiously I can see further changes being made before the bill passes from its current state. And so, as one number, just to throw one number out there, it's currently being said that it will slash, as it stands, this bill would slash 57 to 72% of new projects by 2035 by cutting tax credits by 2028.
So 57% of renewable projects. So like solar farms and tidal and that sort of stuff, wind.
Exactly. Which risks also hundreds of thousands of jobs in US factories based on solar projects that are already also underway. So really, really backwards looking in this moment. And I'm curious to see what the Elon effect is going to be, because he's being, this is another one of these rifts between him and Trump. And he's going back on the attack, saying this is just absolutely ridiculous that this kind of bill could potentially pass. For my own portfolio, I'm looking at this very carefully because obviously EOS is sort of at the crosshairs. And net, I actually think this is bizarrely positive for EOS because as a battery company, even if the supply for overall energy goes down, storage batteries are what will make the energy that is produced more usable and more, it's the middleman that will help utilities sort of balance the power that is made. So the battery storage people will be fine no matter what. It's just that you don't need that kind of, it's still stupid, right? Because I
disagree, I'm afraid. Let me challenge that head on, because I haven't thought about this in advance, but like the reason you need static battery, like grid scale batteries, is because renewables they fluctuate, like the sun only shines in the daytime, the wind only blows at certain times. And you can't rely on them being like consistent. So you need batteries because they spread, like they smooth out the supply, and then you can serve your demand. But if you have non-renewables like oil and gas, where it's consistent, you can have as much as you turn on. So if your energy supply is a higher proportion of reliable, consistent non-renewables, you don't need as many batteries.
Sure, but this is why this is almost a tragic case of what's happening. The difference between the supply and demand is so great that in the time of AI, we need so much more energy than ever before that there will not, like a company like EOS simply will not have any issue meeting the demand quota. They just can't make enough batteries with the demand as is. So that's why I'm saying they'll be fine, because we're talking about gigawatts of deficit. I'm talking about for the greater good of the country. You need a company like both Tesla and EOS and another company to be pumping out way more batteries than is even doable right now. But, if we're talking about 5-10 years down the road, this kind of thing just kills the incentive for even new players. And, I just, as one like fun side thing that I caught on X, now there's talk of possibly Tesla wanting to acquire EOS because the 30 billion, is just floated out there by some like pollsters, because it does make sense, like now that the battery space will need to kind of like get its act together, so to speak, quicker in light of these kind of detrimental incentives as the middleman that could kind of smooth it out. It would make sense for a company like Tesla to buy out EOS and conglomerate and get more scale to grid faster to come and ameliorate, become a better middleman when needed. So I don't think it's going to pass. That's just speculative stuff, but that's kind of one of the things this bill is forcing companies to think about.
Yeah, well, look, scary stuff. In the UK, we're going in the other direction. Like there's actually some controversy in my local neighborhood because there are 3 very large grid scale batteries proposed, and they're sort of coming through like planning approval. And one of them is actually really close to where I live. And there's a lot of concern from neighbors about the safety of some of these installations. So I'm digging into the science around that. But the UK is going, leaning more into renewables and also leaning into nuclear. I think there's a whole bunch of thinking around small modular reactors and maybe large reactors. I think we're bringing Sizewell C online at some point in the next couple of years, something like that. It's like we have a couple of big nuclear generation plants. So there's like another one coming online. So I felt like we're doing the right thing. And nuclear to me seems to be the answer. It's safe, it's scalable. This is nuclear plants today, modern ones, not like 50-year-old ones, do not have the same risks that like Fukushima and Chernobyl faced.
Yeah, so I believe this bill is net positive for nuclear energy. But from my perspective, we're at this inflection point in AI where companies need to grow as quickly as possible, and that's entirely constrained by electricity. And so, another one of these graphics where Elon Musk says a massive strategic error is being made right now to damage solar battery that will leave America extremely vulnerable in the future. That's in reply to Peter Diamandis saying China by 2030 has now the opportunity to increase its lead in renewables. And then below that is another person on X showing a picture of real-time wholesale electricity prices, and those basically are with lower supply and higher demand, prices will start going up, and that's passed down to the consumer. So this is seems to me, again, unequivocally a major blunder in terms of policy, but let's see what the next 3 days bring.
Right.
That does lead me straight, though, to talking about what is now my third largest king of the jungle holding, Iron Energy. And here's what I want to say about this. 2 months ago, early May, I picked up additional shares at $6.26. Iron Energy was posing as a Bitcoin miner. What made me interested in them initially was that they had the best, most efficient Bitcoin mining because they tied it with renewable energy. But that was its sort of surface ad. They were mostly Bitcoin mining. But you already knew, if you went deeper, that they were transitioning to becoming AI data centers. And now it's becoming more obvious than ever that the Bitcoin mining stuff is basically just free cash flow coming in. At the current Bitcoin levels, they're not holders of Bitcoin. They make the Bitcoin and they sell it, and it's just cash showing up on their balance sheet. Their big play, their major play, was to have acquired a bunch of land and starting all the permitting and building that takes years to execute. And now they have basically this portfolio, massive amounts of power that's already online, with massive amounts to come online basically in 26 and 27. And so the reason this is so interesting from an investor standpoint is that we have a bottleneck in terms of AI stuff, and it's not GPUs and it's not basically chips, it's actual electricity. But where are you going to get it if it takes years to actually literally build the infrastructure? So I would say iron, I look at iron not as a Bitcoin miner, but as the fundamental level of AI. And so, knowing that, on our Patreon Dolphins level trading channel, I wrote that I picked up some additional shares at 626 on May 1st, and then just 6 days later, I bought more shares at 655, and I wrote, "Great April update. Pressure from AI to get more power is increasing. Iron will land a deal sooner or later." This referring to from some major AI player like Google or Meta or OpenAI remains unknown. And so I didn't want to wait to add while the shares were quote unquote cheap. Now, here's why I wanted to talk about this. Going back and, everything is obvious in hindsight because currently the shares are up more than 100% since I made those two trades. They're set to open near 15 a share today as we're recording. Here's what I remember when I made those trades, Badger. It's hard when the shares have dropped from about 14 or 15. And if you look at this graphic, it's kind of a straight down from 15 down to about 5, right? You feel everything you know about the DD feels wrong, and it feels like you've made an error somehow. You know what I'm talking about? Like when you begin questioning your own research. And that's why most people sell low and buy high, because it's so hard to mistrust your own mind.
And even when you're that's happened to me many times. And when you're like a professional investor, like even then you start questioning yourself. How did I get this wrong? For me, just a sidebar into like a bit of like owl's nest. When the valuation of a holding I have starts falling precipitously, I don't just panic and do something. That's just a reminder to go and recheck the thesis, look at the numbers again, like reaffirm that I'm right to own this. And sometimes, not always, sometimes that will result in me adding to my position, which is what you did here.
Right. And just so it doesn't seem like I'm taking all the credit for this, I think the most useful aspect, the only real aspect that provides genuine benefit on X for me is that there are some investing communities that do truly outstanding work on particular companies. This is kind of like the old Motley Fool discussion boards where you have real, like that group effect of people sharing their research and critiquing one another. And so Iron is one of these companies that kind of amassed a sophisticated following of experts in infrastructure and building and licensing and AI stuff. And so that's why I began following Iron, over a year and change ago. So anyway, based on the back of all that due diligence, I kind of, if you look at this chart, I waited for the massive drop down to reverse, because as long as the momentum starts, keeps going down, that's more likely probable outcome is it's going to keep going down. But then you see it kind of bottoms out and it has that little bit of a U-turn. And then I basically bought sort of like at the bottom of that as soon as it reversed, so to speak. Now, that is short-term-ish, and that is not the only reason I bought, but that's like another piece of thinking in my cap saying like, okay, all things being equal, now is a good moment and kind of override the psychological barrier and say, no, I trust my DD. The momentum has reversed. It's not as likely that it's going to keep going down further. So let me invest more now. And in hindsight, that was over double in less than a month. Why? Because it seems more clear than ever now, all this stuff we're talking about. Energy is the bottleneck. Iron is one of the companies that has the greatest lead in providing energy for AI data centers. And when they monetize that stuff, it's going to be a cause of massive re-rate, even from these prices. So the moral of the story here is what I did there was hard. It was hard to execute because I basically had to sort of like trust myself. And most people don't do this kind of thing. And there's a little bit of timing involved. And, in hindsight, I look like a genius, but there's also a little bit of luck involved too. But anyone following us on Patreon, could have, saw my reasoning and then could have made a similar decision, which I think would have greased the wheels a little bit, knowing that somebody that has done their work is taking this kind of play rather than it being just a kind of pure speculative bet. So I don't know if that helps or if that.
Yeah, it's a good practical example. Like this, the last couple of months have been pretty wild, like upside, like a lot of stocks have gone crazy, including like quantum computing shitcodes that we'll talk about in a minute. So you've got to be careful here to analyze, like, is this just a company that's kind of turned around on momentum, or actually is there some fundamental reason? But if you've done that work, like great stuff, and you've reaffirmed like why you should own it. Something I think you do really well is I forget the term you use, but like catalysts or something, there's some kind of news coming up and you try and anticipate that news event and then maybe invest ahead of it. And in your IREN message on the Dolphin trading channel, you said there's like a deal sooner or later. Like, do you have a sense of where that might come from or when?
Yeah, it seems, what I've learned during these kinds of negotiations is that CEOs obviously are limited in what they could say publicly. But I really like IREN's CEO. He's an Australian guy and he seems like a straight shooter. And, he's been on the record now over the last several earnings calls, like saying, we are talking to many companies and this deal that's in the pipeline is worth billions and billions of dollars and the demand couldn't be any greater. So they're sort of in the catbird seat. So from my perspective, it's kind of one of those any day now, but it could be tomorrow, it could be next week, it could be next month. But these massive, if you're talking about Meta and they literally need more power, IREN's going to get a pretty sweet deal out of that. So, the telling thing in my message was, I'm just not going to wait. I'm not going to get cute. I know what I know, whether I luck out and it happens like next week or call it November, it doesn't matter to me. The valuation was just way too cheap relative to the prospects.
All right, good stuff.
No, wait, let me say one more thing, because I realized I've now said this twice now, because the pivot is I also bought ASTS shares, which we're going to talk about next maybe. But in both cases with IREN and ASTS, I wrote in the trading channel, I could either wait for big red day or I could just buy the shares now, knowing what I know now. And I chose both times not to wait and just buy, even though the market was high. And of course, as soon as you buy, it feels like the shares will sell off the next day. In both these cases, in this instance, I was right. And I feel like the principle is I refrained from market timing and I acted based on fundamentals and I let the fates take me where they would. So I hope that's useful in some sense. I didn't want to get cute and wait for a better price, because in this case, the better price will be 100% higher had I waited.
Yeah, good stuff. Yep. And it's not black or white. Like you can, as an investor, you can buy like a little bit now, a little bit later, a little bit later. So, there's lots of ways to navigate this stuff. But yes, you're always going to feel a bit like a schmuck if you were planning to buy something and then it doubles before you hit the trade button. But, that's the price of this game, really, the emotional challenge.
Right, yeah. In my mind, there was just a clear line between am I market timing or am I investing based on fundamentals? And when I said I don't want to market time, I pulled the trigger and I got lucky, so to speak, in both those cases. May the luck continue, especially for all our patrons that, are looking at our trades and analyzing this stuff for themselves and also made similar ones.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
So let's pivot the conversation now to AST Spacemobile. And I do want to kick this off by giving like a shout out and a thanks to our Patreon, Stephen, who I think I'm right to say, like he brought this to our attention, or really to your attention initially, like must have been start of this year. Like I was just checking just there, I couldn't see, but like around 6 months ago, maybe even sooner than that. And the stock has been on a tear. like I was not a skeptic, but I was kind of pushing back as a SpaceX shareholder, and we had some like fun conversations about it. And I was mostly like just sort of baiting the bear for a laugh. But I became a shareholder of ASTS in April. I took a sub 1% position in my portfolio because in my mind, this is highly speculative. And now even I'm sitting on a double. So Stephen and you must be doing really well with your ASTS stocks.
Yeah. So major props to Stephen. He's our resident over on patreon.com/Wall Street Wildlife. He's our resident ASTS cheerleader. In fact, Stephen, when I picture you flying your plane, I picture you with ASTS gear and pom-poms. So yeah, but also I know Stephen's position in the ASTS is obviously oversized. And a little bit of history, I actually came across ASTS way before Stephen brought it to our attention when it was like in the $2, $3 range. I started looking into it, but at that point it was perfectly aligned with like the shitco company, and I had enough of that with regard to EOS, meaning the ride was very bumpy and it was in the valley of death, right? It was an issue of will they or won't they have enough financing, and I couldn't tolerate any more of that kind of extreme risk. So I just refused to invest more based on basically risk profile. But I had already done some research on it. And Stephen basically came to our channel and said, you gotta go back and, you gotta backtrack and take a look at some of the fundamentals of this company, basically get serious. And I got serious real quick, looking through all the documents, and it was like, holy shit, this is like a operational thing. And not too long afterwards, I began building my ASTS position for King of the Jungle. And that's when I started poking you in the ribs and squeezing your shoes about its technological superiority to SpaceX.
Yeah. So we'll put the SpaceX thing aside because they're not really competing. Like they're not the same thing. But I do want to compare today ASTS to Rocket Lab. Because I think there is an interesting, like they're not competing either. They're different companies. In fact, ASTS will probably be ASTS will be a customer of Rocket Lab, most likely. So they're supporting each other. But I think something quite interesting here. Now, ASTS is still highly speculative, ultra high risk as far as I'm concerned. Like you guys who've got, I think Stephen might have like a 20% allocation to it. Okay, I mean, that could make sense if you have like a young portfolio and you can take some massive hits. That doesn't make sense for a guy like me where like I live on my portfolio and the numbers have gotten kind of big over time. Now, I've got an 11% allocation to Rocket Lab, and Rocket Lab are they'll become not a mature company, they're still a growth company, but they're becoming more mature. They're almost operationally income positive. They've certainly got revenues. Revenue growth is good. And they've got a real proven business model with proven customers and like a whole ton of customers in the pipeline who want to use their services. And Rocket Lab today is about a $16 billion give or take company. Then, on the other hand, you've got ASTS, which is pre-revenue. Like they generate a tiny couple of $1 million, like nothing material. There's a story, they have a plan. They've put some great groundwork in technologically and also in terms of the business model. Like they've done probably the biggest advantage they have is the deals they've signed with like a number of the world's biggest telecommunication providers. And ultimately the long-term plan is ASTS will put these huge satellites in low Earth orbit, and then they'll allow existing companies like Vodafone and AT&T to provide like high quality, high bandwidth satellite connectivity to their own customers at marginal additional cost. So the business model, like the story is highly plausible, makes a lot of sense, but they're still really young pre-revenue, and they've got a whole bunch of technical hurdles to pass successfully. And today, ASTS is also a $16 billion company. So I look at these two things, Rocket Lab and ASTS, like they're essentially give or take a few bucks. Like they're valued the same. And they, in my mind, are wildly different in terms of maturity and proving the model. So that's why I'm like 11% in one. But my ASTS position is getting close to 2% allocation. Now, I don't want to trim it because we're so early and I've only just bought it like 2 months ago. But at the same time, like I have to sort of maintain a bit of portfolio discipline over this one. I don't know if you've got any thoughts yourself.
I don't disagree with anything you said in terms of, let's say, risk management and stage of life in terms of investing. However, I would say there's a nuance in terms of business model that is hard to, you can't quantify it. It's not in the numbers, but it's pretty simple to understand that as a fan of Rocket Lab, correct me if I'm wrong, I still think of it as kind of like an engineering company, like building extraordinarily difficult things like rockets and launching them and rockets blow up, and like it's always going to be hard and dangerous and things will go wrong, right? In that sense.
Yeah.
But when I think of ASTS, like, and I dig down beneath the layers of it being space, I actually think of it as much closer to a telephone company than a rocket company. Meaning, my understanding of its business model is it's going to be a flip of the switch. That when the satellites are up, we already know the technology works from the satellite to the cell phone. So that's been proven. The margins.
I don't think they've proven that. I don't think they've proven that at scale. So certainly they did some really clever thing way back where they put a cell phone into orbit and they had like the ground stations. They kind of inverted it. You'd normally have like the phone on Earth and then the satellite. They did it the other way around because they could launch literally like a shoebox. So they've proven the technology. They've got 5 satellites in orbit, which are kind of smaller, but they haven't proven the technology in terms of their huge, like football field side satellite. And they have to get it into orbit. Like that's a challenge to start with. And they haven't proven that, like actually providing service to hundreds of thousands or millions of customers.
Maybe this is where it's like looking at the same glass, whether it's half full or half empty. Maybe it's a matter of perspective. I don't see that as like a dangerous challenge. To me, that just seems like an inevitable time. A certain amount of time has to pass before that hurdle, so to speak, is passed. The fact that
let me put it this way. Let me put it this way, which is a bit more like raw. They're going to put into orbit like the largest single thing we've ever put into orbit as one piece, and they have to like unfold it. We're using some very clever proprietary like planning around how this thing will unfold, and they have to keep that biggest thing we've ever put into orbit in orbit. Like there are some things that we haven't done as a species, and they're going to be doing it first.
Right, true. Okay, granted, and for some reason I'm not worried. Because they've already done it, and I don't know, I basically trust the physicists and the engineers, like that just, I don't know, maybe I'm being naive. That's not a concern to me. And therefore, to me, like 5 days ago, they proved their technology works with the fraction of the Army or Department of Defense. And so I just see this as a matter of time, and then the switch flips, and all of a sudden you have revenue going from 0 to billions seemingly overnight with whatever insane margins. So I don't know if this is you being more realistically skeptical or cautious about the technological difficulty and me being naive. But going back to Rocket Lab, it still feels like Rocket Lab will forever and always be in the business of rockets not blowing up, which is the really hard part and the more complicated stuff. Whereas ASTS it's just a matter of time before enough of these satellites are up there, and they're going to get them up there one way or another, whether depending on the provider, the Indian company that's launching in July, or SpaceX or Rocket Lab or whatever. And then whether it's in the next half year or full year, it won't really matter. Sure, there might be a delay, but it's inevitable that they'll be up there. And then it's just a matter of turning the switch on and getting billions of dollars seemingly overnight. So I kind of think it's just very, very different business models that should not be created with the same amount of, call it, risk. And that's why I think that's my best explanation for why both of them could be valued in the same way, even though one already is making revenue and the other isn't.
All right, good. I think we both argued our points fairly well. Like, who knows? And I think like this is an individual investor decision. It's interesting actually to reflect on where you started this bit of the conversation. You were like, I looked at this, it was highly speculative. I had so many highly speculative things in my own portfolio, it didn't make sense to add another one. And this is why investing is individual, because I have very few highly speculative investments. I want more, actively want more. So I'm very happy with like ASTS as a 2% allocation. I probably wouldn't let it grow to a 4% allocation personally, but that could totally make sense. And it could make sense to have a 10 or 20% allocation if you've really done the homework and, you know, like you have an income. And if your portfolio gets wiped out or you wipe out 20% of it, it's not going to impact your lifestyle. Like that ain't me. That would impact my lifestyle.
Yeah. And maybe just to be a little more rah-rah, I kind of feel in this moment of both space and AI development, the stocks we've talked about so far, EOS, Iron, and ASTS, my top three in King of the Jungle, I both feel more confident than ever, which is not, it's not even like 50%, but more confident than ever that if I never sell these for the next, say, 5 years, that the gains will be exponential. And that the hardest part will be both that things go well and that I just don't do anything because the foundations have never been stronger.
And it's great to have like a bunch of bets, because even if only one of those pays off, like the upside is asymmetric. The one that succeeds, whether it's Iron, EOS, ASTS, or something else, that'll cover the losses of the others. And then if you get like a 50 bagger, 100 bagger, well, you know, that's how investing careers are made.
Right. And actually, this takes us full loop to M's comment when he was throwing mud at a poor monkey. This is why there's subtlety in exactly this. There is no correct way. And that's why I think you and I make such a good pair, is because you're teaching people how to invest in a completely, not completely, but in a significantly different context. And there are rules and principles that you do extraordinarily well within that context. And I'm showing people how to do things in a slightly different context. And one is not better than the other. You just have to know which game you're playing and or which combination is right for you, because usually the truth is somewhere in the middle.
Yeah, exactly. Don't trust other people. Like, harvest a range of opinions, figure out what's right for you and your actual risk level and your situation in life and who's dependent on you and what's your kind of employment situation. And, you know, from that, you will come to a more insightful position around how you should manage your own portfolio. We talk about this stuff all the time. Like, if you catch this episode and you haven't hit the subscribe button, well, go hit the button. Let's pivot the conversation to another set of essentially pre-revenue companies, cars. I just added to my entertainment positions around quantum computing puts. So you might remember a few weeks ago, I said I bought Rigetti, ticker RGTI, and I bought like January 2027 puts on that one. Well, I've now also bought January 2026 puts on QUBT, which is the company that you talked about a month or two ago, who were basically like a beverage company that pivoted to quantum computing. And you had some puts, but yours were kind of pretty short dated. You're out of that position. I've got some that are like my next birthday, so I'm hoping these are going to print. I do need the stock now. This stuff it's not for amateurs, and I feel like I'm a bit of an amateur in this space. So this is like entertainment money for me only. It's more, I treat this more like, you know, gambling on the tennis. Yeah, I've got like a couple of $1,000 in QUBT. I do need the share price to halve by then for this trade to make sense. But hey, these companies, in my opinion, are going to zero when the tide goes out. It's just a question of whether the tide goes out before January.
So this is the interesting thing. When you let me know you opened up a position short on Qubit, this is continuously on my radar, and you are now in exactly the same position that I was when I started the short. I had a put that was 6 months out, and that ended up basically neutral. I think I lost $55 total. And so when I saw that you took one out, I opened up my options calculators and I looked at the charts, and I was again very, very tempted to open it up again, but I refrained for the following reason, that this is, as I messaged you, when we're not dealing with fundamentals, to me, this is the best argument for using technical analysis stuff, because obviously reality and price are so widely divergent. That's mostly the algos doing what they do, and market makers and the financial gamesmanship that's happening. And so when I look at the technical chart here, I still see nothing but basically the momentum heading up. And so that says to me that I have to wait until I see that it's reversed enough to begin the downward journey, which of course could reverse and all that, but I'm not, that's the hocus pocus stuff. I'm saying basically I'm going to use my, I'll call it patience to wait. And I have a alert set for when quantum computing drops beneath whatever market average price. And when it does, that's when I'm going to join you in the trade. So yeah, I wish you luck, but probabilities tell me that I'm going to get a better entry point still higher with this kind of circus act.
You could well do. I mean, let's just take a look at the market cap of these two companies. Like, they're about $3 billion. Like, they're both essentially pre-revenue. One earns a couple of $100,000. One earns $9 billion in the last quarter. So $9 billion, if they wish, $9 million. Like, anyway, but the reason I think these are very different in my mind to something like ASTS, because you could say, okay, well, look, these are both speculative pre-revenue companies, but I mean, go listen to our recent episode, I think 2 or 3 episodes ago, where we looked at the Martin Shkreli debate, and like, these companies are valued today, like, and it's not just these two, it's like a whole bunch of other quantum computing startups. Essentially, they're valued like revenues around the corner, like they're going to, just turn on the business model, unfold the satellite, and then they're off generating revenues. These companies, this whole sector, have so many hurdles to jump. And we did it in more detail the other episode, but essentially, you've got to do some fundamental science to figure out how to do quantum computing. Then you've got to do some really fundamental engineering to build this stuff in a way that scales economically. And then you've got to do some business model innovation to figure out how the hell you're even going to use it. Like, we don't even know how we're going to use this stuff if we have it, because it seemingly only solves a very, very tight category of highly domain specific, like mathy type problems. There are too many hurdles there for these to be real investable companies now. Maybe in 5 or 10 years time they will be, when we figured out some of that stuff, but they ain't today. And so that's why I'm very comfortable having my entertainment shorts on these two.
Right. So follow up on that. If I were to open up a short, I would go way beyond the January 26s. I would open up the 27s, because even 6 months is too short, as I found out directly myself. And just to put it into perspective, these companies actually don't make anything, literally. Like, there's nothing, they're there really, on top of everything you've said. When I add the current market cap of EOS is about $1 billion, right? So that means this is a company that's actually literally making batteries already, and it's valued at 1/3 of these companies that might only possibly make something 5 years from now. That's insane. And if you even to switch the analogy to ASTS, if you add both of these, that's about what, 6 billion in market cap. ASTS is, call it, that's half or 40% of ASTS. Right. ASTS doesn't have any revenue, but they actually have satellites in space, and they have all these agreements in place, and they have, conversations with US senators and blah, 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 blah. That is vastly different than a science project that might work 5 years from now. Like vastly, vastly different. And in between, the amount of dilution that shareholders are going to experience with quantum computing stuff, especially fraudulent ones that used to be beverage companies or quasi-fraudulent, however way you want to understand, it's not even the same thing. Not even close. That's why I look forward to joining you on these shorts.
Good stuff. Yes, get back in. Excellent. But not too much. Like, don't have massive exposure to these, because who knows, right? The world can stay irrational longer than we can stay solvent. Now, I know we've had a long episode, but I do just want to touch on one aspect around some thinking from Aswath Damodaran, like the dean of valuation. This guy's like a professor / investor, and he's a very well-renowned guy when it comes to how to value a company. We might go deeper into this in a future episode, but there's just one thing I want to pick out. And Damodaran kind of positions people, investors, as either being like numbers people or story people. And we typically belong to one of these two groups. And like, just personally, like, I was a story investor for realistically like the first 15 plus years as an investor. Like, I was just investing on, I suppose, hype, if I'm really honest. And then I became a numbers investor probably late 20-teens. And then for the last 5 years plus, I focused much more on the numbers. And I think these things go hand in hand. Like, you have to have both. But when you've got a pre-revenue company, like the ones we're debating now, like ASTS and these quantum computer companies, there are no numbers. So all you have is the story. And that can be true for even mature companies like Tesla. We talked about that in the past. Like, the story is so important to Tesla that it makes it almost impossible to produce like a realistic set of financials and a valuation model, because there's so much potential in some aspects of the story. Like, you may as well not even bother doing like a discounted cash flow model, because it ain't going to tell you squat when the story drives the outcome so much. But for these companies, the story is all there is. There's no financials to look at because they have no financials. And so what Damodaran says is, he's got his 3 Ps test. And I hadn't seen this before. I quite like it. He says, is the story possible? Is it plausible? And is it probable? And I'm going to diverge from him a little bit, because he says, because he's the numbers guy, he says, like, many stories are possible, few are plausible, and only a handful are probable. Your story must answer every one of the 3 Ps with yes. It must be possible, plausible, and probable. Now, I don't think that's necessarily true if you're, by design, deliberately investing in very early stage companies. But to my mind, at least, I mean, you have to be clear-eyed as an investor about where the story lives on that kind of spectrum. And to me, the ASTS investment, it's certainly plausible. The business model makes sense. The engineering makes sense. And I don't know that it's probable. Like, for me, it will become probable once they actually put one of these giant satellites up and unfold it and start delivering with one of their partners in one geography. At that point, it becomes probable because they've proven it. But at that point, like, you've probably, well, you've not missed the boat as an investor, but you'll be paying a multiple of today's valuation, even today's $16 billion valuation, as soon as they prove it, because a lot of the risk has gone away. But these quantum computing companies, like, I guess they're possible if we're really optimistic and, open-minded. It's possible that there's a business here that will generate economic value. Is it plausible that these companies will get there in the next 10 years? No, it is not plausible that that will happen. It's certainly not probable. So I like Damodaran's framework. It helps us get a bit more concrete about our thinking. And I think you can apply it with nuance when you're thinking about some of these like companies that just have no numbers whatsoever.
Yeah, this is great. This made me think immediately to one of my core investing principles. Hope is not an investment strategy. And to that point, this is curious because regarding the ASTS, I actually answer number 3, probable, as it is probable. You're saying you're not as confident in that, but that's, a kind of subjectivity that is, I think it has to remain. It's not, no one will ever give you a definitive answer, but I could confidently ask myself, am I merely hoping, or am I answering all of these, in that kind of increasing level of depth in at one point, like regarding, let's say, biotech, some of it is, still stuck between 2 and 3. So I know for this biotech investment to work, it's kind of, there is a little bit of hopium involved. With ASTS, I could say, nope, it's actually more a matter of time. So I'm not so much as hoping as waiting, even though nothing's guaranteed. But this is I'm so glad you brought this to us. This is a great refinement, I think, on top of that. Are you hoping, or are you looking at things clear-eyed?
Yeah. And I was having a debate on X last week, because we talked about it in last week's episode, my position on like Tesla, should they use LiDAR or not? And I had quite a few voices come out of the woodwork, like respective other FinX names, who are quite anti my position. But my view was, look, I'm just trying to be clear-eyed about this. I'm trying to say, will Tesla actually solve like robo-taxi? Will they deploy these things at scale reliably, and they won't be like murdering people one in every like 100,000 journeys with the current technology stack? And just, I think it's useful to explore that side of it, explore the bear case, not just kind of shut down and go, nah, not listening when other people are maybe challenging your thesis. The most useful thing, well, going back to the start of the episode, right? Networking, sharing your investment ideas with other smart people, ideally who have a bit of an investing background and understand like what it means to be an investor. Like that's how you learn. And if you're having those conversations with people who believe different things to you, that's how you learn the most, as long as you keep your ears open and like understand their position. Because it takes two to make a market, and the bears are never exclusively right and the bulls are never exclusively right. The truth is always somewhere in the middle.
Agreed. I don't know if a poker analogy here it would confuse things or make things clear, but even like, I just immediately thought of aces. Is it possible that aces can win? Of course. Is it plausible they could win? Of course. Is it probable that aces win? Well, that begins to depend, right? How many hands are in, right, before the flop and so forth. So even something like aces, for that third one, shifts. Before the flop, sure, it's probable. After the flop, definitely you have to adjust and so forth. But that's what we're dealing with all the time.
Great stuff. Alrighty. Good episode. Good chat this week, Krzysztof. So you're going to be making your way to Sicily. I hope that journey goes well for you.
Thank you. Next time we record, probably it will be back with me stuffing my face with banana-flavored cannolis.
Can I give you a task? Like on your road trip, get some video for our Patreon of you like cruising along and giving us like your thoughts on whichever beautiful bit of countryside you're coming through, and like try and tie it into investing in some way.
Yeah, if I make it to an opera house in Vienna, I'll be sure to send some Mozart your way.
Well, we kicked a whole bunch of like investing research around today. We used our favorite investing tool, fiscal.ai, previously known as FinChat. So if you want to use the same tools as we do, fiscal.ai/wildlife will get you a handsome discount off of any subscription.
Are you ready to be a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.